So I want to give you guys the latest of what's going on with AMC stock as well as in the broad markets because things are weird. Things have been weird and they continue to get weirder by the day. And how does this affect AMC? I think that's a big question that people have. Kind of what's next? I know is a big question. So let's get into this information. We're going to talk about what happened last week, what's happening this weekend. Happy Memorial Day as well. You guys enjoy your weekends and thank you for being here. Thank you for growing your knowledge base and staying up to date with this information. And not even thank you. I mean, you're doing this for yourselves. You're doing this for your family. So um that's awesome. Okay. Now, first things first, it's this weekend's about the debt ceiling. Now, Biden said that negotiators were very close and that he was very optimistic about reaching a debt limit deal. And what he said is, quote, I hope I, I hope we'll have some clear evidence tonight before the clock strikes 12 that we have a deal. Biden told reporters on the South Lawn of the White House shortly after 6 p.m. Eastern Time, and this was on Friday. Quote, it's very close and I'm optimistic, he said. Well, doesn't look like we got that so far here today. It says, quote, I'm hopeful we'll know by tonight whether we are going to be able to have a deal, Biden said. So what does that mean? Does that mean maybe we don't get a deal? Quote, we continue to have major issues that we have not bridged the gap on, Republican negotiator Garrett Graves of Louisiana told reporters Friday afternoon in the Capitol. So there's just a lot of conflicting information here. And if we take a look at Kevin McCarthy's Twitter, I'm sure if there is a deal, this will be the first place you'll see it. You're not getting anything. You're just getting more of the same old, same old. Kevin McCarthy 3 hours ago. Democrats want to spend more and tax more. Republicans are fighting to change that. It's really that simple. And retweets and just that we're not going to tax more is basically what he said. So no progress, it looks like. And we got the debt default day, I guess, if you want to call it the X day, you can call it whatever you want. Now it looks like the government might not run out of money until June 5th. Now, this buys a little bit of time, but it's really coming down to the wire either way. Now, I don't think the real problem here is an actual default. I don't think that's really in the cards, and I don't think that's going to happen. But if we get downgraded, that's going to be a big problem as well. Fitch said on March 6th of 2023 that America's credit rating could get downgraded even if a default is avoided. And then they come out and just put us on negative watch on Thursday, meaning that soon we could get downgraded. It's not good. We've only ever got downgraded one other time in history, and the stock market fell about 20% in that period. It fell 6.5% the next day after that downgrade. The downgrade actually occurred on August 5th of 2011. That was a Friday, and you did not open for trading, I believe, until August 8th, 2011, and that's when the markets were down 6.5%. So it was a very negative experience last time around. Yeah, August 5th, boom, and then you open for trading August 8th, and you were down 6.5%. Good news is you kind of bounced from there. You traded in a very volatile range for a while. You fell a little bit lower, and then the bear market was kind of over here. So We'll see what happens if it would be that bad or if we get downgraded at all. What Fitch has basically said is America risk free if every couple of years we're faced with a possible default? Probably not, okay? So it makes sense why our credit rating would get downgraded. And that means higher interest rates. That means um kind of like lowering your credit score and you're going to get a loan, right? Imagine that. You go to the bank one day with a 740 and then for your mortgage. And then when you finally go to actually buy the house, they run your credit again and it's a 700. Well, your interest rate's going to be a little bit higher and you're going to have to pay a little bit more for the house every month. So that's kind of the same way that you can look at this. It's not a good thing. So we'll see what happens with that situation. A big story of last week that the markets really just don't care about right now, which is actually kind of crazy. The AI bubble has really taken over the markets, but inflation came in really bad, really bad on Friday. You had core PCE price index month over month coming in at 0.4%. You were expecting 0.3%. Personal spending came in hot as well at 0.8% compared to an estimate of 0.3%. Personal income also came in hot at 0.4% from the estimate of 0.3%. Durable goods orders also came in strong. You were expecting negative 1.1%. Came in at 1.1% positive. So across the board, bad, very bad data for inflation. Super bad. I mean, core PCE at 0.4% on an annualized basis. Sheesh. Is what? 4.8%? And that's for PCE. This probably means the next CPI report we get on June 13th, the day before the next Fed conference, the next Fed meeting, is probably going to be hot as well. This has caused the probability of a rate hike in June to completely flip. At one point, there was a 99% chance of the Fed pausing in June. Now, there's a 64.2% chance of a rate hike. And markets just went up. Markets just went higher. And there's clearly signs of a recession is coming. If you look at the bank sector, if you look at some of the cyclicals, you're seeing pain, a lot of pain. Look at a Target, look at retailers as a whole. They're not doing so hot. So even something like a Disney even or whatnot, they're not performing the way that these AI stocks are, which typically doesn't lead to an end of a bear market, but technically you're in a bull market because markets are up over 20% from the lows. So I think this is a problem, and it's probably going to come back to haunt the markets at some point. As far as when, that's very hard to say. But do be on the lookout for a possible downgrade over this weekend. That would not surprise me. I think America rightfully deserves their credit downgrade, just based off the shenanigans that we're seeing. Now, what was that? Let me see. Okay, let's go ahead and get into some of the data here with AMC stock. The short score is at the highest level that it has been at in a very long time, at 90. So you're looking more prone to a short squeeze now, according to Ortex, than you have in a long time. Short interest, that is dollars that are currently sold short, $511.27 million. Estimated short interest on free float at 21.07%. Free float out on loan 33.9%. Shares out on loan 175.05 million. Days to cover 6.11. Cost to borrow 56.08%. And 100% share utilization. If you take a look At the live cost to borrow fees, you're looking at about 69% for the cost to borrow average, cost to borrow max at 109%, cost to borrow minimum 8.27%. Interactive Brokers has a 51.1% cost to borrow fee with about 500,000 shares that are currently available to be lent out. So cost to borrow fees still a huge problem for hedge funds, for people that are short on AMC. It's really not the situation that you want to be in, right? Cost of borrow fees are no longer like 1,000%, but they are still biting very hard when it comes down to it. Now, as you guys know, in the last couple of weeks, AMC stock has not been moving because people are negative on the company. Quite the opposite. I think more people are bullish on AMC fundamentally today than they were in the past year and a half. But you've seen a lot of option activity, a lot of that bearish option activity that really just pushes the stock down. You've seen a lot of shorting. Sometimes, guys, the volume is 40-50% shorts from market makers based off these these $13 puts. They just keep shorting these into the ground. And I think that's a problem until it's not, meaning that that's going to push down the stock until you actually get a reversal, until you get some kind of new information. And at that point, those market maker shorts, they get covered based off the price action of AMC, not if hedge funds want to cover or not. It's if AMC stock bounces, shares get bought back. That's how that works. It's not discretionary like a hedge fund, right, where they can ride up or down a short position. No, if you're shorting AMC using these puts that are deep in the money, once you get to that break even for market makers, they're going out and they're buying stock, okay? And think of it like this. Simple math, if a hedge fund bought a $10 put on AMC and they paid $5 for that, $500 a contract, well, that means that if AMC breaks above $5 per share, market makers are going to start buying stock again. They're going to start buying back some of those shares that they are shorting, because same way it works like a gamma squeeze, right? People go out, they buy calls, market makers have to go out and buy stock as well. And that's where you get a gamma squeeze. I think everyone's very familiar with the gamma squeeze, but a reverse gamma squeeze, not so much. When hedge funds do the opposite and they go out and buy puts, well, market makers, they have to short the stock, right? Because it's the opposite. They buy on the call side with a gamma squeeze. They sell, they short on a reverse gamma squeeze. And that $5 level is going to be very, very important. So it's non-discretionary. Like if a hedge fund takes out a short position of 1 million shares, they can choose whether to, stay in that short position. If the stock were to go to $6, $7, $8 per share or higher, they don't have to cover unless they are forced to cover. Market makers, on the other hand, they're not trying to be net short on a stock that could potentially short squeeze. That's not how they work. They get in and out of positions. So when AMC stock does start to actually rally, it's non-discretionary. Market makers will purchase millions of shares of AMC, and it will work the same way as a gamma squeeze once AMC reverses trend and actually does bounce, because we've talked about the math here. We've looked at it, guys. Even just in one of the last videos, we looked at the option activity for that June 16th expiration, and you're looking at over 60 million shares that are currently likely sold short by market makers based off of the in-the-money puts alone. So that's a big point that a lot of people need to realize. It's non-discretionary. If GME has good earnings and it sends AMC stock up higher, market makers, they're going to buy back millions of shares of AMC. Granted, the volume in AMC is very low, in between, call it 10 and 15 million shares trading hands every day. that's going to very positively affect AMC's share price, guys. So that is going to do it here in this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.